Hey, how's it going? In today's video, I'm going to be telling you the truth behind interest rates and everything that you need to know when it comes to buying a house with a loan. I'm going to go ahead and break the ice. This stuff is ridiculously complicated. I understand that the home buying process is very stressful, but the entire point of this video is I want to teach you about how interest rate works and how you can go ahead and understand whether or not your interest is a good deal for you. Because right now, there are a lot of lenders, there are a lot of builders, and there's a lot of programs that are offering you can get the lowest interest rates. You'll be able to get a 3% interest rate, 4% interest rate. Right now, the current market for interest rate is a 7.25% or around that 6.5% to 7% interest rates at the moment. A lot of those low interest rate promises are actually it's just a bait and hook strategy. They just want to go ahead and promise you a low interest rate, but they're not telling you what you need to hear, nor are they going to be teaching you exactly what you need to understand to even know if you're getting a good deal. The main point of this video is, first of all, teach you on how your interest rate works and how to determine whether or not you're getting a good deal. So to go ahead and get us started, let's go ahead and look at an example. Let's just say that we're going to be buying a house for $300,000. So if we were to go ahead and do a conventional loan, 30-year fixed rates, and let's just say you have a 700 credit score, so I can go ahead and get an interest rate quote, you're going to be getting around a 7.25% interest rate. Okay. So if you were to do 3% down for the down payment, you're going to be spending $9,000 for the down payment. And also the payment on the house is going to be $1,985. Where does this $1,985 come from? This basically comes from the 7.25% interest rate, the $291,000 loan that we are taking out, and also the 30 years on the loan. Now that we have our monthly payments, this is when we can basically calculate how much money are we going to be spending in terms of interest, or in other words, how much money are we literally losing. Now, a lot of people understand this, but I'm going to be doing my best to teach you on how your interest is calculated. So what you need to do is you need to get your 7.25% interest rate or your yearly interest rate, and you divide that by 12. So for example, if we were to have a 12% interest rate at this moment, that is going to be a monthly interest rate of 1%. For the example of this video, we're going to be going ahead and doing a 7.25% interest rate, because this is actually a quote that I got yesterday with a 700 credit score, a loan for $291,000, 3% down for a purchasing price house of $300,000. Here I have a little example of how is your interest calculated. What ends up happening is you get your monthly interest rates, which, like we said, you get yearly interest rate, you divide that by 12 to get monthly, and then you get this monthly interest rate and you multiply that by the loan amount. So when you go ahead and you multiply that by the loan amount, you already have the payment that you're going to be making towards your interest. So for the first month, when you make your first payment, you're going to be spending $1,758 for that first month in terms of interest. And then the difference from that, from your total payments, that's going to be going towards reducing your principal balance. On this example, $1,758 is the interest. If we get the difference, you're going to be reducing the loan amount of that $291 by $227. When we go ahead and go to the next month, your interest payment changes. Okay, so you get that same interest rate and you multiply that interest rate with your new loan balance after you made the principal payment. So if you recall, it's no longer $291, it's actually $290 and $772 because we've reduced the principal balance. So then what ends up happening is your interest payment changes. Instead of it being $1,758, it is now $1,756, which is a reduction of around $1.25. Your principal payment also goes up by that same amount proportionally. Instead of paying $227, when you make the payments for the principal for the second month, you're going to be paying $228.38, which is still the total payment of that $1,985. And we go ahead and take a look at month 3. Like I said, you literally get your monthly interest rate, you multiply that by your new loan amount. This is going to be your new interest payment for the third month. Then to get your principal payment, you get your total payment subtracted by the interest payment, and that's your new principal payment. So what is the difference here? What happens if we take a look at this in terms of a longer term approach? Just for the 3 months, on the third month, our interest payment is $1,755. What was the difference from when we first made the payment? Well, the first payment was $1,758. Now it's $1,755. Woohoo, $3 difference. Great. In the very beginning, you're paying a lot in terms of your interest because you have a larger loan balance. So the most important thing that you need to take away from this entire video, and I'll be happy with you watching this video just for up until now, your interest payment depends on the loan amount and also your monthly interest rate. So right off the bat, I can tell you when the loan amount goes all the way down to 145,000, you're going to be paying half in terms of interest. So instead of you paying 1758, we are looking at around $800 to $900 in terms of interest. Now, what does that look like in the grand scheme of things? Well, I actually have this beautiful chart here, which is called Excel, and I already have all the details for that for you. So here we see our principal balance after month one is 290,772. What we want to look at is, when is our interest payment going to be half of that? So divide that by 2. I want to know roughly, when am I going to be paying $879 in terms of interest every month? Literally what we're going to do is we're going to be looking for that 879 and scroll all the way down. So scrolling. Oh, we just passed it. So 879 is right here. So on the 264th month, that's when we're going to have a payment of interest of 878. The biggest takeaway from here is that your interest payment depends on your loan balance. So the larger payments that you can do in terms of your loan balance, the less money you're going to be paying in terms of your interest. Now, when you make your first payments, you're going to be paying mostly in terms of interest. So any additional payment that you can make towards just paying down your loan balance is literally going to kickstart your balance by a huge amount. Let's just say for the first year you own the house, you literally just make a $230 payment in terms of just paying down the loan balance. You basically just save $1,700 in terms of interest if you were to pay an extra $230 for that entire year. So what happens if you make an entire $2,000 payment? Well, that's roughly going to be around, let's just say, 9 months of interest you can basically save, which is going to be around $15,000 of interest that you would have saved just by making that extra loan payment. Now, keep in mind, this would be making that extra loan payment just to reduce the principal balance. Now that you have an idea on how that works, we can now talk about a little bit more complicated topics and like, okay, how do you know if the interest rate you have is a good deal? Because everything is not in terms of just the interest rate alone. I'm actually telling you about this stuff so that you have an idea on like, okay, what's the significance of interest rates and how does it work more or less? So the next thing you need to understand are closing costs. So let's just say in a perfect world, you were to buy a house with nothing but cash. All right. You have it like that and you don't need a loan to buy a house. So the only thing that you'd be paying for would be for property taxes, insurance, and then title. Those would be the costs just for buying the house and making sure you have insurance and also making sure you're paying for the property taxes. But what happens when you don't have 6 figures of cash? Well, you need to take out a loan to buy a house. So closing costs are the fees involved for going ahead and needing to take out a loan to buy a house. So the next thing we're going to go ahead and do is we're going to be talking about the closing costs for a loan, because that is very, very important when it comes to talking about interest rates. Let me explain why. Here is basically a loan estimate, but I put it in terms of a spreadsheet. Total closing costs are going to be $14,276, which may sound like a lot, but let me go ahead and talk about these fees. So origination charges. So when it comes to origination charges, these are going to be charges when it comes to an underwriter fee or fees associated for doing the loan and who you're going to be paying. And on top of that, this is also going to include potential discount points. Now, remember discount points because that can drastically change how much you're going to be paying in terms of closing costs. So right now, the only fee that I have here is $10.50, which is pretty standard when it comes to paying the bank the underwriting fee that they charge. Here we have $1,050 for an underwriting fee. So here, services borrowed did not shop for. I'm quoting it to be around $1,000. Basically, this is the cost of doing the appraisal and additional minor fees. Now, the services you did not shop for, here I'm taking into account title. If you don't know what title is basically a glorified receipt ensuring that you are the owner of the property. All right. And that's going to cost around 1%. So $3,000 for a $300,000 house. Next thing we have is taxes and other government fees. These are basically just recording fees. So when you go ahead and have all the glorious loan documents and papers, the title company needs to go ahead and submit all that information with the county to basically put on record that you are now the owner of the house. And they also have a copy of it and establishing that you are the owner of the house. I'm simplifying it a lot, but this is just go ahead and go over these fees. Now, the next thing, prepaids and escrow. So when it comes to talking over prepaids, there are going to be two things that we're going to be paying for normally. You're going to be paying for a whole year's worth of homeowners insurance, and you are also going to be paying for per diem interest. So what does that mean? First of all, the easiest thing is a homeowner's insurance. So when you buy a house, the bank's going to ask you to have a whole year's worth of insurance on the house that's already paid for, just to make sure that they're covered. Because if you look at it like this, the bank is lending you 6 figures of cash. They would at least like to have insurance on the collateral for the property, because in a way, the bank also owns the house. The bank wants to make sure that their house is safe and has insurance. Now, the next thing we're going to talk about is the per diem interest. So what is per diem interest when it comes to your prepaids? If you recall, when we had the monthly interest rates, so if we go back here to this example, so for that first month, we have an interest payment of $17.58. You literally get this $17.58 and you divide that by the amount of days in the month, and you're going to be paying an extra certain amount of days depending on when you close in terms of the month. So for an example, let's just say that we are going to be closing on the 20th. You're going to have to pay 10 days proportionally in terms of the per diem interest. So in the case of this example, that is going to be around $600, because when I went ahead and estimated the homeowner's insurance, I said that was going to be around $200. It may be higher. It just depends on what you choose for your deductible. But if you were to annualize that, that is going to be $2,400. That's how the prepaid is calculated. And then the next biggest sunk cost is going to be the escrow. Here's the way you look at it. When you were to buy a house, you're going to be paying for two things regardless. You're going to be paying on a yearly basis insurance. If you want to have insurance, you probably want to have insurance. And then the second thing you're going to be paying for are property taxes, because if you don't pay your property taxes, the county can just take away your house. So basically what ends up happening is, if your account is escrowed, which most of the loans are escrowed, the bank is going to have you place a cushion or a certain amount of set months for the insurance payment monthly and also the property tax payment monthly in a separate account, because you only make your hazard insurance payment and also property tax payment once a year. Typically what the banks do is they just have you pay this escrow account so that they can go ahead, withdraw that money from that account and make the payment when it's due. So that's why you have a lot of this large upfront in terms of closing costs. Now, this is technically money that you don't lose. This is money that you're going to be spending regardless. And then on top of that, in the prepaids, when you pay for that whole year's worth of insurance, you're going to be spending that money regardless. If you were to go ahead and add up all of these fees, plus a little bit in terms of the per diem expenses, that is technically the money you're air quotes losing. That's the money that you're not going to be seeing back. And that's more or less the money that I would expect in terms of the money that is lost from doing the loan and buying the house. Because all the other fees, when it comes in terms of the insurance and taxes, you're going to be spending regardless. So I already went ahead and added up all of that together. Technically, the money that you lose is $5,786. Let's just say $6,000 just for simplicity's sake. This is going to be coming from the fees that you pay for origination charges, the services you did not shop for, such as the appraisal and other minor fees, and then also having title insurance on the house, which is 1%, and then other minor fees such as the recording fees and also the per diem interest. So if you look here, this is the money that was spent and air quotes lost. And this is the actual true cost of taking out a loan to buy a house. I know this sounds like a lot, but you need to understand this to determine whether or not the interest rate you have is a good deal. Because look, a lot of the lenders are going to be saying that we can get you the lowest interest rates, 4 or 5% or whatever, it doesn't matter. Because what they're doing is they're increasing the closing costs in terms of their origination charges. The way they're increasing it is by increasing the discount points. So what is the truth behind interest rates when it comes to buying a house? Well, the devil's in the details, because when you have a particular interest rate, you also need to take a look into the closing costs. How much money is it going to cost me more to basically buy the house? So I already have a baseline here, which is a quote where we have a 7.25% interest rate. And the closing costs, if we were to not buy any discount points, that's going to cost us $14,300 roughly. Here's what a lot of lenders are going to do. We can get you the lowest interest rate. Instead of getting you like a 7.25%, we'll get you a 5%. And you're going to be saving a lot of money in terms of interest, blah, 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 blah. Okay, great. But what they also don't tell you is that you're going to be paying a lot more in terms of the closing costs. All right. I'm going to go ahead and simplify this a lot more down. And I'm just going to tell you how much you need to spend in terms of total money out of pocket. Basically, if we were to take into account the closing costs and also the down payments, you're going to be spending around $20,000 to buy this house for $300,000. It's not perfect on terms of the adding up the down payments and also the cash to close, but That's because I actually have additional credits, which is basically giving you credit for property taxes. To buy this house, how much is it going to cost you out of pocket in total? Well, here I have $20,000. So if you want to get the house, $300,000, and you take out a loan for $291,000 at a 7.25% interest rate at 3% down, you're going to be needing to spend $20,000 out of pocket. How do lenders convolute the interest rates and try to hook you with a very, very intriguing interest rate or very, very low interest rate? Well, I actually have a spreadsheet right here that goes over the interest rate lock. So believe it or not, this is how I go ahead and disclose rate locking options when it comes to talking to my clients. Typically what I just show them is this first page here between rates and cash to close. The most important thing here is how much money you're going to be spending in terms of your discount points. So right now we go ahead and take a look at the mortgage estimates. We're only going to be spending $1,050, and that's going to be the underwriting fee from the lender that the lender is going to be charging. Right now we are paying $0 to get this interest rate. This is typically called par. This is the rate, the 7.25 is the rate you're going to be getting without spending any money. This is because of your finances at a 700 credit score, conventional loan, 30-year fixed rate. You're going to be getting a 7.25% interest rate for a $291,000 loan. You're not going to be spending any extra money out of it. Typically, the way lenders try to promise you a lower interest rate is they don't include the cost for the discount points. Let's just say you didn't like the 7.25% interest rates and you're like, oh, I only want 6%. I'm not going to be taking anything less than 6%. Great, cool. I can get you the 6%. However, you're going to be spending $14,555 out of pocket to get that interest rate. So on top of that $20,000 that you need to spend, you're going to be needing to spend an additional $14,500. So instead of coming in cash to close with $20,000 down, you have to come cash to close to $34,500 out of pocket. So that's typically on how lenders are able to basically hook you with low interest rates. And then once you're under contract or you're a little bit deeper into the whole entire process, you're like, hey, look, you're going to have to spend out of pocket an additional $14,000 at closing if you want to get this interest rate, which goes in terms of the discount points. So that's one of the ways that lenders are typically going to be trying to hook you in terms of getting the interest rate. Well, this is actually the truth behind getting a lower interest rate option. Now, when it comes to buying a house, there are a lot of things attached with buying a house, especially with a loan. For you to understand the truth behind interest rates and home loans, you need to understand what are the costs associated for buying a house. The entire purpose of this video is to teach you on how to look at interest rates and compare it to see if it's a good deal or not. You can go to any lender, you can go to any bank, they're going to tell you what you're going to want to hear. I want the lowest interest rate. Cool. You just have to spend an extra $14,000 to buy down the interest rate. As long as you understand that's upfront and you know on how that works, perfect. By all means, go ahead and slam all that money in. Great. You'll have a low interest rate and you'll be good to go. However, I'm going to be giving you some insights on like why it's maybe not worth spending all that money for discount points. The only time that I suggest to buying a house and paying for all the discount points is if you're going to be living in the house for more than 4 to 5 years and you don't plan on doing any type of refinance. What is a refinance? So a refinance is a big old another loan to pay off your first loan so that you can maybe get a better interest rate. So what ends up happening is this. Right now, the market for a 700 credit score, you can get a 7.25% interest rate. What happens 1 or 2 years down the line? Interest rates go down. Let's just say 1 to 2 years from now, you bought the 6% interest rate, you spent $14,000, but now interest rates changed and then interest rates are now at that 6% mark. You're not going to be seeing the benefit of paying that $14,000 until you wait 5 years to at least break even. All right. If you spent that $14,000, you're not going to be seeing the benefits of that interest rate until you've stayed in the house and you've kept that same loan for at least 5 years. And then at that point, that's when you begin to start seeing a little bit of the benefits of buying that interest rate. The only time I don't suggest paying all that money for discount points is if you don't plan on doing a refinance in the future and you also plan on living in the house for at least 6 years before you go ahead and sell the house. So when does it make sense to pay for the discount points? Well, first of all, you need to think of it like this. How long do you plan on having a loan? If you plan on having a loan for more than 5 to 6 years, maybe at that point it's worth paying all that money out of pocket. However, that is a large sum of money that you're going to be spending that could maybe go down towards reducing the loan balance or maybe having cushion in the bank account. I typically don't suggest people to spend the money in terms of the discount points unless they plan on keeping that loan for the next 5+ years, because at that point you may start seeing the benefits of paying for that discount points. But at the same time, you also have to take into account on what's the status of the market. If we were to go ahead and take a look at interest rates, past year we've been kind of consolidating this whole entire time for the buying the house. But at that same time, you also need to keep in mind what happens if interest rates go down at a lower rate. I mean, you kind of wasted your basically $14,000. You could have basically just stayed with the same interest rates at that 7.25%. And let's just say rates went down to that 6%. Well, if we recall, what was the money that we technically lost in terms of doing this entire process? Let's just say $6,000. If you would have just waited that 1 to 2 years, you would have gotten that 6% interest rates, but you would have only spent that $6,000 for all the costs associated for doing the loan again. Basically, what I'm trying to tell you is this. Normally, it's not good to buy down unless you already have money that you literally don't plan on spending regardless. And on top of that, you are going to be staying with that same loan for the next 5+ years. Now, the next thing, when does it technically make sense to spend money in terms of buying the discount points? Well, it really just depends on the loan structure and how the deal is done when it comes to buying a house, because things definitely do change when it comes to buying a house if you do have some seller concessions and if the seller is going to be paying for title costs. Seller concessions. What is seller concessions? Seller concessions basically money that the seller of the house is going to be using to help you buy the house. So that seller concessions can go in terms of the closing costs, down payments, or other things like that, which could reduce the total cost out of pocket. But let's just say you're pretty much fine 100% with spending the $20,000 out of pocket, and you want to go ahead and use those seller concessions. So let's just say we got 3% for seller concessions, which is the $9,000, but you already had a budget of $20,000. Well, at that point, if you don't use the seller concessions, you can just say goodbye to that money because it's just going to disappear and go back to the owner of the house. At that point, that's when I go ahead and suggest, hey, look, you know what? Let's just go ahead and use that money to go ahead and buy down the interest rate because I'm not going to be using the money at all anyways. So at that point, what you can go ahead and do is here we see around $9,000 is at 6.5%. I was planning to use $20,000 regardless. And we also got 3% seller concessions. Instead of getting a 7.25%, we'll go ahead and get a 6.5% for the house, and we're good to go. So at that point, that's not money you're necessarily losing. But at the same time, on the flip side, you can also go ahead and say, well, instead of paying $20,000, I'm fine with paying $11,000 out of pocket. I'd actually, instead of paying $20,000, I actually just want to have all that go towards all the closing costs of the $14,000, and let's go ahead and have that go towards basically reducing the money I need to spend out of pocket. Even then, that's up to personal preference. It's really up to you on like what you want to do. The main entire point of this video is this is the truth behind interest rates. When you're taking a look and you're buying a house, you need to take a look at the closing costs and take a look at the interest rates, because you need to know truly out of pocket what is the money that you're going to be spending for that. You can easily be promised a 6% interest rate right now, but I'm pretty sure you wouldn't want to double the money that you had to spend out of pocket to buy that house. I wouldn't want to do that with me, especially if I'm locked into a contract already. So that is basically everything that you need to know when it comes to understanding interest rate and getting a loan on a house. That is all for today's video. I hope you were able to understand a little bit more in terms of the truth behind getting the lowest interest rate for a house and how this entire process can be very, very complicated and also a little bit convoluted, because I mean, it's very, very easy for me to promise you, oh, cool, you can get a 6% interest rate. But what is actually the cost associated for getting that interest rate? So the entire point of this video was to teach you, first of all, how does the loan work in terms of how you pay your interest, and on top of that, what are the costs associated for getting a home loan? How much money are you going to need to be spending additionally out of pocket to do that loan? Now, that is why the best mortgage is not necessarily the one with the lowest interest rate. It really just depends on the big picture of like how the market is, if interest rates are going to fall, how much money you need to spend out of pocket, how much money do you want in terms of your savings, and all the different things that can go into basically buying a house. If you can do me a huge favor, like and subscribe. If you're in the process of buying a house, or you know someone who's in the process of buying a house, please feel free to share this video. And if you need help getting a loan here in Texas, please feel free to reach out to me. My phone and email are going to be in the description and also comments. And yeah, I mean, that's pretty much it. If you also need a realtor, please reach out to me. I also know multiple realtors here in the United States. That is all that I have for today's video. I hope I was able to teach you a little bit more in terms of your understanding when it comes to interest rates and home loans, and why the best mortgage isn't always the mortgage with the lowest interest rates. There's a lot of fine writing in between the lines, but at least hopefully at this point, you know just a little bit more. Thank you very much and have a great day.